Uh, it has been a long day, so I'll try to keep it crisp and short. Let's see. But the theme that I wanted to speak to about is not that light. It is pretty dense actually, and if resolved correctly, it can generate at least 200 basis points of additional economic growth that our country can enjoy. So let's dig in. I'll be talking about credit inequality and the growth that we don't see because of this inequality. I will be focusing largely on the small businesses of our country, typically what we technically call as the MSMEs, the micro, small, and medium enterprises. There are formal definitions to them, let's not get into it, but we all understand what a micro business is or what a small business is, right? So what do you see on the screen? By the way, this is again all AI generated. What do you see on the screen? A couple of businesses, right? So I have this small-time barber shop. All of us would be aware of such small-town barber shops. Many of you would have encountered them. I have encountered them belonging from a small town. Now this Prem runs a shop, pretty successful at that. He's a micro business, has just one chair. That's pretty okay for the time being. On weekends, there is some queuing up, but he manages, okay? He's just scraping the surface. He's able to feed his family, and that's that. And then on the other side, what you see is a ready-made garment stitching unit somewhere in Tirupur. Lakshmi is the proprietor. She's sitting on that automated machine. But the other machines, you will notice, are all manual machines, very old model. Now, what is stopping them from growing further? If I tell you that today's small businesses don't think the problem is skilled labor, they don't think the problem is effort, enthusiasm, innovation, demand, or even infrastructure. The most important problem today that they face is permission to borrow. And the reason I'm using the word permission is deliberate. And I'll explain to you how in some time. So let's say Prem wants to buy one more chair and expand his business. What will happen? My basic back of the envelope calculations tell me annual revenue could rise by 5 lakhs, and Prem gets to hire one more worker, which means job creation. Now imagine 6 crore MSMEs hiring one employee each every year. That's 6 crore of employment right in front of you in a country where employment or unemployment is such a big issue, especially amongst the youth. And we talk about demographic dividend, right? Let's look at Lakshmi. If Lakshmi were to buy one more automatic machine, the one she is sitting on, that machine can stitch 20 to 25 extra garments per day, and every seat where there is an automated machine can generate an annual revenue of 2.4 lakhs per seat, which means expansion of business, which means hiring more workers, which means more global contracts. But there's a big problem. It's not that there are no tailors available, it's not that there are no barbers available, they are available aplenty. It's the machinery, the money to buy the machinery, it's the money to buy the chair. That's the problem. Permission to borrow. Now, there was this survey which was done by Small Industries Development Bank of India, or SIDBI as we call it, in 2024, where they asked a bunch of MSME entrepreneurs across the country, what is holding you back? Why are you not growing? And you know the majority of the answer, I just told you. More than 30% of those guys said, we just don't get access to credit. Sometimes the credit is not enough, and sometimes there is no money at all. And far fewer numbers together said labor was a problem, infrastructure was a problem, customer demand was a problem, and this is again SIDBI report. Now, what is the aftermath of this? Because our new age entrepreneurs, the small ones, are not getting credit, they are gradually being forced to continue to borrow from moneylenders, the sahukars of the economy. They are informal. They can charge whatever interest rates they want. RBI doesn't monitor them. And they can use coercive methods to extract the money out of the customers or the borrowers, right? So there's this another survey, which is a kind of a rolling survey, which is done by CMIE, which is known as the Consumer Pyramid Surveys. And what I noticed in this data is, between FY19 to FY23, and this is accentuated post-COVID, and you will see the one which I've circled, self-employed entrepreneurs. The CAGR of such self-employed entrepreneurs who is accessing credit from non-institutional sources, matlab shahukars,
is much higher than the ones who are borrowing from institutional sources, which would be your banks, NBFCs, fintechs, and whatnot. And this is creating the problem of growth, because at the interest rates which the Sahukars charge, you cannot really do capex with that money. The best you can do is borrow short term, invest for working capital, and just manage to stay afloat. Now, that's the biggest problem that the country faces. You may ask me, why is it a big problem? Small enterprises, none of us work for small enterprises. All of the speakers who came before me were all from large enterprises. You, most of the times, will be working with large enterprises. They are borrowing, they are investing, they are doing capex, they are adding to the economy. So where's the problem? This is might be a fringe fringe problem. But that's not the case. This is the relevance of MSMEs in India. 90% of India's entrepreneurs or enterprises are MSMEs. There are about 7.5 crore MSMEs, out of which 6 crores are listed on the government portal, Udyam, and the rest are not even listed. 60% of our workforce is engaged with MSMEs. That's 25 crore of workers. 30% of our GDP is coming from what these guys are producing in the economy, both in the services and in the manufacturing space. 44% of what they're producing are getting exported. So you see that they are not fringe elements, and we cannot just forget about them. There has to be a way, there has to be a new thinking amongst formal lenders to ensure that our MSMEs, our new age businessmen, the young blood who wants to do new business, they get the credit they deserve. And here is the problem. On one hand, they are giving 30% of our GDP, but when it comes to credit, 7% of total bank credit has been given to them. This is the outstanding bank credit. And this is MSME, which includes micro, small, and medium. If I remove the medium ones, which are still better off, and if I just talk about small and micro, this number falls to 4%, and it has been declining instead of increasing. And that is the problem. Why has it been declining? Maybe that's a topic for a different TED theme. But obviously, Indian banks have become much more risk averse because of other shocks they have faced. I'm not blaming them any which ways, but that's a problem. And this is how things have shifted, say from FY11 to FY25. The mix of a commercial bank's credit disbursement has been moving in favor of retail loans and shrinking in favor of industrial loans. So today the situation is such that if you go and seek credit to buy a mobile phone, you will get a very easy credit, no questions asked. But if you want credit to create a shop where to sell this phone, you will not get that credit. So this is the situation where we need to change. Now, since banks have been pushing back, a whole set of new lenders have been trying to cater to the MSMEs. And the first and the foremost are the NBFCs. I belong to one such NBFC. Some of my previous speakers also belong to similar NBFCs who are trying to make a difference. But you know what? The size of NBFCs are so small, so bank balance sheets are about 5x the size of total all the NBFCs taken together. There are 9,000 NBFCs, imagine. Even then. It's like the deficit which has been created by a bank is a big, barren lake, and the NBFCs are like water tankers trying to fill that lake, which is never going to be sufficient. So again, a gap is created. That gap, there's this another set of entities who in India we call them alternative investment funds or AIFs. In the US we call them private credit. They are trying to take advantage of this situation, which is again for all the right reasons. If there is a business opportunity, capitalists will take advantage of the business opportunity. But like private equity, private credit also chases yield. And the typical interest rates which a Farallon or a Cerberus or a Apollo or even the Indian guys, Edelweiss, Kotak credit funds would charge for such loans would be anywhere between 20% to 30%. Now you tell me which small business in the country can generate returns or profits more than 30% so that this loan is profitable for that guy. So again, they are stuck in working capital short-term loan for basic sustenance.
And finally, you may ask, well, India has a very well-defined bond market. The size of the market is growing by the day. Government is doing so many things to improve the bond market. Why doesn't these MSMEs go to the bond market? There's a different challenge. The bond market is a members-only club even today. Why do I call it a members-only club? Because the guys who get access, or the companies who get access to this bond market in India, are currently the ones who have a credit rating of anywhere more than AA. So AA is one of the better credit ratings. It ranges from AA all the way to AAA with various other segments. But the large corporates are the ones who can generate such credit ratings from a CRISIL or a ICRA. These are rating agencies. The MSMEs, they typically land up with a credit rating which is less than BBB, who have no space or very little space in the bond market. So I was looking at some statistics to prove this point. Last 5 years, 85% of the funds that were issued in the bond market came from all these AA or above rated companies. Less than 20% funds were generated by companies who are lesser than or lower than AA rated. So this path of funds is also not much there. So NBFCs are not sufficient, credit funds are expensive, bond markets are not deep enough to support anyone who is less than BBB rating. So jaye to kahan jaye? Well, the government has acknowledged this problem. They have done a lot in the last 10, 14 years. Schemes like Mudra scheme, PM Mudra scheme, PM Vishwakarma scheme, the credit guarantee schemes, the CGT, MSE, that is, they're more colloquially called, they have done great work. They have helped millions or crores of MSMEs access credits by their network of banks and NBFCs, which is a good thing, right? But there also a gap has been created. Now these banks and NBFCs who are routing funds through the government schemes don't want to onboard people whom they don't know. Whom they don't know means people who are new to credit. Businesses who have never borrowed in the past, they are getting left behind. So the smaller guys who have never reached out to the loan market in the past because they have no history, and hence they don't have any history, any paperwork, any collateral to offer to the banks or the NBFCs to take part in the Mudra scheme or Vishwakarma scheme or the credit guarantee scheme, are still being left out. SIDBI statistics alone suggest that 42% of our registered MSMEs, that is about 2.6 crore enterprises, are in this new to credit category who has never borrowed in the past, and hence they are not also getting credit even today. So even if the government is intervening very heavily, there is still a segment who are getting left out, and this is creating this issue of no paper, so no credit, so no payment history, no payment history, so no paper, so no paper, so no credit. So this is a vicious cycle that we are seeing across these 2.6 crore listed guys, and there will be plenty more who are not non-listed. Incidentally, Prem's barber shop, I'm sure, is not listed. So this is the situation. How do we solve it? Now comes the more important problem. Earlier today, or let me just also share this story of how things can get solved, but are not getting solved in scale. So let me tell you the story of a bakery shop in Mysore, or one of the suburbs in Mysore. It's not in the city. It's a generationally owned and run shop. It has been there it was built by the current owner's grandfather's father. And till now, the shop was okay, catering to the local demand, and life was good. But when the new generation, the couple came in, they wanted to expand. They had more education. They knew how financial systems work. They knew how consumer demand can evolve. They had seen stories of Italian pizza chains, etc. So they wanted to do something in their bakery. For 2 years, they were trying to get a loan from banks and all the known areas, and they were being refused. Till one day, they reached out to a fintech company. Now this fintech company, one of the underwriters, an over-industrious underwriter, noticed that they have this huge pile of vendor invoices, which are hard copies, okay? And his team tried to digitize it. And this was like 5 years of vendor payment copies. After digitization, they saw 2 strong trends. One, the vendor payments was increasing by the day. So the growth rate was phenomenal, which means the business was really doing well. They were buying a lot more flour than they were buying 6 months back, or they were buying a lot more sugar, and all the vendor payments were increasing at a very hefty growth rate. The other trend that they saw was this guy, 75% of the times, was on time in making payments to the vendor, which means the business's financial health was also quite good. So along with some of the other new age data points like GST, IN, etc., they used this also in the underwriting process, and lo and behold, the underwriting outcome came as give them the loan. So this is the small change. There has to be a change in the way banks are asking questions in order to identify businesses who can really do well with this additional loan or the long-term loan that they seek. But how do we institutionalize it? One fintech doing it, fine. This guy was good, this underwriter was good, he did it. But how can you institutionalize it? The way we can easily institutionalize it, and our chief guest alluded to that in the beginning, is our free data infrastructure. India Stack. Now we all know what India Stack or UPI has done to payments, but that's just 50% of capacity utilization of India Stack. The other 50% lies in can we do that revolution in credit, and not just retail credit to MSME credit, to CAPEX credit. And because of the huge amount of data that India Stack can generate for the underwriters or the banks or the NBFCs, I don't think this is a difficult task. It just needs the right intent and the initial amount of hard work, which will enable a vast segment of the MSME sector to get institutional credit from low-cost lenders. So let me end the session, thankfully, with what I started. The biggest barrier to entrepreneurship in India is not talent, it's not effort, it's not even ambition. It is the permission to borrow. When credit is flowing only to those who already have it, the old to client, old to customer, not the new to credit customers. Old to credit customers are getting it, the new to credit customers are not getting it. We are creating an inequality in the system which will become a very systemic problem 10 years down the line. We'll not be able to fix it then. But if we have the benefit of data, if we have the benefit of digital infrastructure, let's use it right now. Let's stop this inequality from spreading further. So, if you want inclusive growth, formal lenders should stop or move away from asking who can we safely lend to asking who can grow if we lend. Because credit is not a charity, it's infrastructure, and unless, like other infrastructure like power and roads, unless it reaches everyone, the entire nation is not going to be able to benefit from it. So, what India needs is the permission to borrow. Thank you.